Hello, everyone. Rob Wolf here from the Loan Factory, and you are watching my YouTube channel, the Lone Wolf Podcast, or you're listening to my podcast, the same name, Lone Wolf Podcast, and that's loan spelled L-O-A-N as in borrow money. You can reach me by email, rob.wolf@loanfactory.com, or here, give me a call on my cell, 727-366-5722. I'm in the ABC business, always be communicating. I'm available 7 days a week, and sometimes even on vacations where I've been known to give someone a pre-approval letter up in the Rocky Mountains. Speaking of the Rocky Mountains, I am licensed in Colorado, where I vacation every year, Pennsylvania, where I grew up, and Florida, where I live, in the great Sunshine State. Yeah, did you know that not every loan officer is licensed? You may want to check that. Just a little tidbit for you. This podcast is just me, but if you are in the real estate field and you want to be a guest on my podcast, give me a call. We can work something out. Hopefully you're in the real estate world. You're a contractor, maybe title company, whatever it may be. And we'll work something out. That way you can put it on your website, promote your business. I keep these podcasts under 30 minutes. I think this one will be around 20, give or take. And I put them out there every Wednesday night. But if you miss one, no worries. Just go to Google and put in your search engine, the Lone Wolf Podcast, and I'll come up there. So I'm going to talk about interest rates and lender credits. Okay, so you as a buyer looking for homes, obviously you want to get pre-approved and you're looking for the best interest rate out there. And that's a big key because a 1/4 point interest rate on a loan over a 30-year period comes out to a lot of money. Now, the other thing you want to be considering is the service of the loan. And I'm not talking about once you close, I'm talking about getting you to the closing table. Okay, so I want to take a couple minutes and caution people. I see a lot of stuff and I've heard a lot of stuff about people calling these companies. They Google on the internet these low rates. I always caution people about the low rates because typically if it's a really, really low rate, you may not be getting the service. And what do I mean by service? I've heard this before, that they will call a company and the person will help them out. They're in some cubicle, whatever you want to call it, some company, and they're giving them information. They may be pre-approving them. Okay. Now they may not be pre-approving them the right way, which is another story. But then when the buyer says, okay, this is great. Thanks a lot for your help. Let me give it some thought. I'll give you a call back. And then when the person tries calling back, A, they may not get a hold of the company because the company may be closed at 6 o'clock or whatever it may be. B, they're going to get a different person. Okay, so I caution you, just make sure that when you're talking to a lender, that you got the assurance that, okay, if I call this number, am I going to get you or am I going to get somebody else? Okay, again, this is my phone. It's my only form of business that I have besides this computer. Okay, so you're going to talk to me. So make sure you get that out of your lender. The other thing I want to talk about is when you talk to lenders, ask if they have in-house underwriting. You know, that's a big plus. Now, this isn't the underwriter that works for the lender that is going to be critiquing your loan after you have a contract signed. But an underwriter that works for the lender's company is very valuable because there could be scenarios with your loan that you want to make sure you cover before the loan gets processed. You know, you could be changing jobs. You could be receiving a gift letter. You could have some inheritance coming. Whatever it may be, it may not be a cookie cutter clean loan. And I want to run this by the underwriting team to make sure that we're not going to run into a snag, because once you have a contract signed, you've got a timeline. You've got to get to the closing table. It's typically less than 30 days. And so you need to lock into that rate. But during those 30 days, there's a lot of stuff that has to happen in the background. The appraisal has to happen. The title work has to get going. There could be other inspections, not your home inspection, but there could be septic tank inspections, whatever it may be. These are all things we need to keep moving. And if there's something in your loan that we can make sure that gets past underwriting pretty quick, okay, that's very valuable, because if you don't close in time on 30 days, the lender's going to charge penalties. Okay. And it could be, I don't know the fees, maybe a couple $100. But more importantly, the buyer's going to be pretty upset because they worked their whole schedule to get everything out of that house, and you're not closing on that day. And maybe they're already out of state planning to fly back for the closing table. Okay, you get my point. Just make sure that you get the assurance from your lender they're going to do everything they possibly can, and they have the tools to get you to the closing table on time. Okay, so couple other things. When I go over these 7 or 8 items, it's not an exact science that if you follow all these 8 things, this is the exact interest rate and the exact lender credit you're going to get. Okay. Every lender has its own way of conducting their business. That's why you shop around, but this will at least explain why your interest rate or lender credit will change. Okay. And the last thing I'll talk about, as I'm going over these things, just think of the risk versus reward. Okay, the lender is taking a risk to lend you money for 30 years. The bigger the risk they are taking, or they feel they're taking, would be a higher interest rate that you're going to pay. Okay, so just keep that in mind. I'll give some examples as we go along. Okay, so let's get into the meat and potatoes here. Let's start with the big one that I think we're all aware of that's very important is credit. Okay, there's a minimum credit score. Otherwise, we can't even be considered to get a mortgage. Okay, it'd be 580 for an FHA loan, 620 for a conventional loan. VA is 580, but there are some exceptions to that. But we understand we have to have a minimum credit score. And in the mortgage field, if you have 760 or above, that's kind of considered the gold standard. Okay, but one thing I want to make sure that if you have, let's say, a credit score of 640, don't stop there. Keep trying to raise that score, because how it works with the mortgage field is that it's in 20-point increments. So every 20 points that you can raise your score, 620, 640, 660, and so on, you could get a lower interest rate, or you'll get more of a lender credit. Okay, so for example, let's say we have buyer A and buyer B. Everything is equal. They're shopping for the same house and whatever, but buyer A is at a 630 score, buyer B at 730. Buyer B, they may both have the same interest at 6.75%, but buyer B may get a lender credit of $2,000 to help them out on closing costs, because the lender feels that they are less of a risk, because that person with a 730 credit score has a history of paying on time, and they're less risk. Okay, now let's go back to that 630 person. And this is even more critical. Once you're shopping for homes, okay, this is even more important to keep increasing your score. The worst thing you can do, especially after you have a contract signed and you lock in an interest rate, do not go on a shopping spree to get furniture for the house, a big screen TV, whatever it may be, okay? You have to buckle down, because God forbid you go on a spending spree, you open a credit card account, something like that. What if your score drops below 620? You won't get the loan. Okay, so talk to your lender and make sure that you're on the same page. And the other thing about credit, Loan Factory has a very good relationship with Rocket Mortgage. And Rocket Mortgage, they have a department that will look at your credit history, and they'll do simulations. And they'll get back to me to get back to you to say, hey, John, Jane Doe, if you can take care of this or this, we might be able to increase your score by 25 points and then do a rescore before closing, and you could get a bigger lender credit. Okay, so check with your lender if they have somebody that does that does simulations to help you out. Now, this is not, I repeat, not a credit repair. We're not licensing that. We're just running simulations that could possibly help you get a higher score and a better lender credit. Okay, DTI, debt to income. Okay, when you go shopping for a mortgage, there are limits to how much debt you can carry depending on the loan amount. Now, for example, let's say someone makes $120,000 a year. I know that's a lot of money to most of us, but for simplicity's sake, it makes it easier. Divided by 12 months in a year, that's $10,000. Okay, we look at the gross monthly income. So we have $10,000. Most lenders, they don't want you carrying more than 45% debt. That'd be $4,500. Okay, this is all your debt, including the new mortgage. So when I, as a loan officer, that's what I'm doing to see what can be the maximum that you can go shopping for a home with your existing debt that you have right now. And when I say debt, this is your credit cards, it's your car payment, it's your medical bills if you have any, your student loans if you have any, and any other debt, even if you co-signed for a loan, that's going to be on there. Okay. Now, let me talk real quick about student loans. It's a political ball that goes back and forth. If you're watching this right now and you're not making any student loan payments, there's a bereavement, whatever it may be by the government, okay. But I, as a loan officer, I have to put a number down there. At this time, it's 0.5%. Okay. So if you have $100,000 in student loans, I've got to put $500 a month on there. Okay, so just keep that in mind when you want to go shopping for homes. Okay, so okay, we hit the credit. So that's kind of how that works. DTI. Okay, down payment we hit. The type of residency. Okay, is this a primary house, secondary house, or an investment property, like a duplex, triplex, quad? Okay, your secondary and your investment properties are going to be a higher interest rate. It's a bigger risk to the lender. Why do you say that? Well, let's look at it this way. Let's say you have a primary house and you have a investment property. If you start running into financial problems, if your renters aren't paying on time, which home are you going to make sure you're going to make the payments on? It's your primary house. You don't want to lose that. That's why the secondary house and the investment property carry higher interest rate. Okay, keep that in mind. The type of loan, I touched on it earlier, conventional, FHA, VA, but there's also USDA loans, and there's also first-time homebuyer loans. There's loans out there that if you're below the median income of a county, you get certain lender credits. So make sure you tell your loan officer, I'm looking for a conventional loan, FHA, whatever it may be, but they all have different interest rates attached to them. The term of the loan, is it 30 years, 20 years? Now, we as loan officers typically default to 30 years, but make sure you tell your loan officer, I'm looking for a 15-year loan or a 20-year loan. So keep that in mind because they have different interest rates. Your employment. Okay, I'm not saying I agree with this, but lenders look at people that are W-2 employees working for corporate America are less of a risk than others. Okay, so when we pre-approve you, I'm only looking for 2 years worth of continuous employment, the previous 2 years. Okay, so if you change jobs, as long as you don't have a big gap, more than a week or two, that'll be okay. Now, if you have more than a 2-week gap, especially more than a month, with FHA, that's not going to work. Okay, you probably won't get the loan. There could be a reason with conventional, maybe relocated from California to Florida, vice versa. Okay, there's a story behind it. Getting back to the underwriting I was saying, okay, these are things you need to discuss with your loan officer to see if it'll make it. My point being is a W-2 employee would probably have the best interest rate, whatever it may be. Self-employed, that's a bigger risk. Now, chances are if you're self-employed, you're probably using tax deductions and your gross income is lower. So you might have to even go to a non-QM loan, which I've done videos on that. But keep that in mind. The other one is you don't want to be changing jobs a lot as you're looking for a home. Okay. I had one buyer, she had 3 jobs within 2 years and was looking for a 4th. And I told the buyer, you don't want to do that. And the person was really confrontational, saying, what's the big deal? I'm working. I said, it is a big deal to the lender because it's showing inconsistency. You're not steady. They like boring. Okay. When you change jobs, it's not a good sign to the lender. Okay. So make sure that when you're shopping for homes that you keep that in mind, that you don't want to be changing. Stick with the same job. After you get the loan and after you close and whatever you want to do after that, that's up to you. But again, make sure that you've got steady income. Assets. And when I say assets, I'm talking liquid. What can we get fast? What's in your checking account, savings account, 401k, stocks? We don't really care about cars. Some people put that on the application. That's not really necessary. I will say this though, you don't want to have cash, and I mean literally cash. You've got to get that into your bank account because the underwriters will see if you've got $10,000 cash because you're in the hospitality industry and you've saved up this money for a down payment. Well, you've got to put that in your bank account on a steady basis because we want to avoid money laundering. Because that's what the underwriters see is what this cash, you're not paying taxes on it. What's going on here? Okay. Now, if you are in the hospitality industry, that would be a letter of explanation that your loan officer would do, but you have to be putting the cash in on a weekly basis, at least, because obviously you're getting tips. Okay. So make sure that you're not literally have your cash in a vault in your house or anything like that. But if you've got checking and savings where your paycheck is going to, that's good. If you've got a 401k plan, put that down as an asset. If you've got stocks and bonds, put that down because again, you can liquidate a 401k to pay your bills. Not ideal, but you can. And then you can sell some stocks and bonds or whatever securities you have for cash in case something goes wrong. So you want to show that because again, getting back to my example, if I've got someone that's just starting out, they're saving every penny they have for their down payment of a townhouse or condominium, whatever it may be. They may not have a big 401k or anything that they can kind of fall back on. Whereas someone that's been in their career for 20, 30 years, they've got savings, they've got a 401k, stocks, whatever it may be, they have more assets. And that's what the lenders look at, that, oh, this person has, that's 20, 25,000. That's their life savings they're throwing into this. And here's another person, they've got $300,000 in life savings. It's less of a risk for the lender to give to the person with $300,000. Okay. So just keep that in mind as you're shopping for mortgages. So hopefully, this completes what I wanted to discuss. Hopefully this helps out that you understand why people are getting different interest rates and lender credits. And you should be shopping around, asking lenders what their rates are and ask the other questions about what they have. Make sure you're talking to the same lender. If you have any questions, concerns, again, hit me up. I'd be more than happy to answer any questions for you. And again, I'll see you on the next podcast or the next YouTube video or listen on the next podcast. All right, folks. Once again, Rob Wolf at loanfactory.com or rob.wolf at loanfactory.com or 727-366-5722 is my phone number. and I kept it under 20 minutes. All right. Have a great day, folks.